So this is what I believe the holy grail of investing is. If you can do this, you will make a fortune. You'll be very successful. And it's simple, really. Maybe not simple to pull off, but simple concept. If you can get 10 good uncorrelated investments, 5 good uncorrelated investments, 15 good uncorrelated investments, you can substantially improve the return to risk ratio. And this just shows how it works and why diversification is more important than being good, even, in picking the best investments. And most people think, give me the best investment and let me put all my money in what I think is the best investment. Wrong. Find your best 10 uncorrelated investments and put your money in that, and you're going to do a lot better. And this just gives you an example. So this is the standard deviation, let's call it the risk, of 10%. And just imagine I put in an asset, I'll use a simple example, that has 10% return and 10% standard deviation. So let's say it's 10% return, 10% standard deviation. And let's say I put in a second investment that is 60% correlated with that, third, fourth, fifth, and sixth, and so on. This is how my risk in my portfolio would change. That means, like, if you have a diversified portfolio of stocks, average stock is about 60% correlated with average other stocks. And you can put in 100, you can put in 1,000, and you are not going to materially reduce your risk relative to putting in, just 5 to 10. And you could see that that'll lower your risk by 10 or 15%. If you have an uncorrelated return stream, and you can get actually better than uncorrelated because you could have negatively correlated, but let's say I put in an uncorrelated return stream, this is how the line goes. So you could see, like at 5, you've more than cut your risk in half. 5 uncorrelated return streams. If you have down to 15, you're going to reduce your risk by nearly 80%. That means you've improved your return to risk ratio by a factor of 5. So you can reduce your risk a lot without reducing your return. And that is the key to it, right? So when I look at this, I think that there are 2 types of assets. What's your strategic asset allocation mix? What is your beta? In other words, what portfolio do you normally have? And in my opinion, it should be highly diversified, but with along those lines in terms of like half in growth, half inflation, rising or declining. And then alphas. You have to have a lot of different alphas. Like in our case, we have well over 100 different types of alphas, about 130 different kinds of markets actually in terms of trading. So that's it. Thank you for your patience. Let's have a conversation about it.